The past month or so, I'm telling you guys I'm nervous about the markets. I've been this nervous for a couple of years. It was because of the uncertainty, right? You have uncertainty when it comes to tariffs and trade with China, where, depending on what Trump's going to tweet that day, it's either good news or positive news. Basically, that every other day it changes, right? It's great. Oh, go to a trade war. We're not. We're going to solve it. We'll go to a trade war. It's like it's just kind of crazy how the market moves so much on that. But there is uncertainty. Washington is a complete mess, right? I mean, that by now you should know. I don't care what side you're on. These guys don't care about you, don't care about me. They just care about power, right? But there's a lot of uncertainty, nothing getting done. Nobody cares about infrastructure plans or anything crazy. It's just, hey, if one person comes up with one idea, the other side, the other party's going to disagree with it, no matter, even if it's great. Just that's the way it is. That's a big risk with Washington. You have Brexit. I mean, is it happening? Is it not happening? I mean, what's the latest, right? You have the international market seeing a lot slower growth, pretty scary. Europe, even China, seeing overall slowdown in earnings growth. In our newsletters, there's two stock newsletters I have, Courtesy Research Advisory, Courtesy Venture Opportunity. Took some money off the table in those, not a lot, but did cut some losses, also took some profits in several positions. And I also said last week that, we are starting to see a lot of insider buying, which is a positive, particularly names that have gotten crushed, even though they posted solid earnings last quarter, which, took place, a few weeks ago. Maybe asking, why would these names get crushed after posting strong results? Because the results for the quarter was strong, but they refuse to raise their full year guidance. So if you're supposed to earn $1 in the first quarter, just say, and then you earn $1.30, at the end of the year, it's supposed to be $4, again, hypothetically, you would think that you would raise it because and they're not raising, which signifies that maybe things aren't going to be that good. It's not that. It's more about management teams don't know what's going on. I mean, tariffs could impact these companies tremendously. It's going to affect their supply chains, and they're being conservative. So again, a lot of uncertainty going on, but we are seeing insider buying. A lot of companies with tariffs gotten hit over the past month. It's starting to rebound a little bit, not just China names, but even retailers. People really do believe there's going to be an actual trade war, long-term trade war. It's going to be terrible between China and the U.S., whatever. We've seen some stocks go down 25, 30%. For me, I like to see the insiders buying, especially when they just reported pretty good numbers. So I'm getting to a point here because if you follow other analysts, which a lot of you do, or money managers, newsletter writers, whatever it is, often when they make a call similar to like I have, or they just have a call in place, it's kind of like forever. This is how I feel. Position yourself accordingly. Buy treasuries, short growth stocks, short Europe, buy utilities, consumer staples, and gold. And you know the drill. But over my 25-year career, I've seen, not only seen, I've actually worked directly for permabulls and permabears. A lot of these so-called experts are never going to change their opinion regardless of the facts. I bring up this example sometimes, which is the credit crisis, where the whole world was pissed off at Wall Street and there was so many problems. Talking about after we've come out of the crisis a little bit in 2010, 2011, but there was permabears saying the market's going to crash again. It's going to be worse in 2008. Yet, if you just took a step back, you would realize that the government was backstopping everything, took all the bad debt off the balance sheets of just about every major financial institution, guaranteeing it. They invest directly into banks, AIG, GE, Fannie, Freddie. They gave checks to individuals to buy cars and homes, and they lowered rates to zero. It's a history repeats stuff. First time in history, zero interest rates to create inflation. But if you took the emotions and all the agendas out of the equation, you would have realized that every asset was about to surge. There's basically no risk because everything was being backstopped. So you should buy a home, art, collectibles, and of course own stocks, since interest rates were so low that investors had no choice but to push more money into stocks. And we're talking trillions of dollars where people are looking for no risk income, right? That's the goal. And when you can't get that in treasuries, or you can't get that interest rate zero, it forces you to go into other avenues, especially assets and consumer staples and utilities, and the multiples on those things went up tremendously because they also paid a yield. But the permabears and permabulls, right, these so-called experts that basically never change their mind regardless of the facts, are incredibly dangerous to you and your portfolio, but more importantly, your generational wealth. That's the money you're going to leave behind for your kids. I mean, people telling you to buy gold, buy gold, buy gold for how long? Put it under your bed, put it under your bed while the market went up tremendously, right? They didn't take a step back and just looked. And there's a lot of things out there. I'm not picking on people who are wrong, but to really push the gold theory out there, why you should own gold and the dollar's going to disappear and riots in the street for the last 10 years with all the things that happened over that time frame where, I don't know, it just, if you really took a step back and didn't have an agenda, you probably would have said, okay, maybe I should allocate 5-10% to gold, not so much into it. And you know what? You significantly underperform the market in one of the biggest bull markets in a generation. Where am I going with this? Great investors are always willing to change their minds on a dime if the facts change. And I have to tell you, I've been bearish. There's an indicator I follow for the past few years that's been dead on when it comes to predicting market moves. In other words, it's a great leading indicator. And you know what? It totally contradicts to what I've been telling you, saying that you should be cautious right now. And for me as a researcher, I love reading stuff like this. Sometimes people hate it. Like if you are, even politics, if you're a Democrat or Republican, you really, even if it's a good idea, you don't want to hear it because it's no. For me, I love listening to the other side. I mean, you're a research analyst. You want to get all the facts straight. You want to hear the positive and negative. You don't want to talk to everyone who's positive on the same thing that you're positive about. You want to get the story right, and that's how you make money. So for me, I love talking to experts who have a different opinion than me. It just validates my thesis. Or, could change it depending on, what information they're saying. But yeah, we all want to get our predictions right. And to do that, the more people you listen to, every source, the better chance you have on doing that. Now, this indicator, it's called the Global Fund Manager Survey. Okay, it's a survey published with Bank of America every month. So basically, Bank of America surveys around 230 fund managers. And combined, these guys have about $650 billion in assets under management. It's a big deal. So they survey them, ask them a bunch of questions. They'll tell BofA about the allocations, expectations for the global markets, bond market, economy, domestic equities. Now, the last survey was taken between the 7th and the 13th of June and was published yesterday, which is Tuesday. I want you to listen to some of the data points from this month's survey. It's a quick heads up because it's about to blow your mind. At least it should, because it blew my mind. It was very surprising. Some of the things they found from the survey: investor confidence, the most bearish since the global financial crisis. Really? Right now? That's how bearish you are? I'm bearish, but not 2008 bearish, right? Very surprised. This is by the people who invest in companies, in stocks. $600 billion plus of assets under management. This isn't just a survey of CEOs or things like that. These are money managers that are putting money to work. They have a bull bear indicator that's dropping to almost the biggest buy signal that they've seen in years. The cash levels, again, from last month, surged to 5.6% from 4.6%. That's a surge when it comes to cash. To put that in perspective, the biggest jump in cash since the 2011 U.S. debt ceiling crisis. That's how nervous these guys are. Look at equity allocation, second largest drop ever. When we talk about equities over bonds, how people are going more into bonds. Lowest drop since 2009, second largest drop in equity allocation ever. Growth expectations. They plunged by the largest amount since November 1994. When you're looking at the Fed and how they view the Fed, in 8 months, in just the past 8 months, the percentage of investors expecting higher short rates has flipped from 89%, right? Everyone's like, hey, rates are going higher. It's like zero. Lowest since 2008. So you're looking at these indicators. You're seeing a massive rotation of capital into a bearish stance. And this is just June. So the rotation is going to bonds, cash, staples, utilities, going away from equities, banks, Eurozone, technology. But you have to look at this as a contrarian investor. And it should make you really bullish. Because if you're bearish like me, basically part of the crowd, and I told you more times than not, you don't want to be part of the crowd. When everything leans to one side, which everything's leaning to one side, this makes me worried that stocks could move significantly higher from here. Now, I have no idea where stocks are going over the next month, 6 months, 9 months. But for me, as someone who's cautious right now, it definitely alleviates some of my concerns about stocks falling hard. It makes me take a closer look, especially at the sectors that underperform, especially at the companies that are down 25, 35%, where insiders are buying. It gives me a little bit more conviction. And you look at the smart money and how they're positioned. Remember, when it comes to fund managers, the stock market is a game. They need to beat their benchmark, period. That's it. That's your job. That is your job, to beat your benchmark, period. That's it. If you ask any fund manager, what's your job? To beat the benchmark, not to make you money, whatever. It's to beat your benchmark. So if the market falls 15% and they lose 7%, that's a massive win for them, even though they're down 7%. Massive. Yet if the market's up 20% and they're only up 10%, it's a huge negative. They could lose their job for that. Why? Because why would you pay that guy or that fund massive fees when you could buy an S&P 500 index fund, which outperformed you, and pay what, 0.14%? That's actually the percentage on the Vanguard S&P fund, 0.14%. But being the benchmark, that's how they get paid bonuses. That's how the employees get paid bonuses. It's how they get raises. It determines if they're going to keep their job. So if stocks are running higher, which we're seeing over the past couple of weeks, while they're on the sidelines, they must find a way to catch up to generating alpha, which basically means they're going to have to start buying stocks to keep up with their benchmark, unless they want to lose their job, unless they don't want to get bonuses. And with so much money on the sidelines, and so many of these hedge fund managers and fund managers really nervous to the point their allocation between stocks and bonds is near record high in terms of being conservative, you could see stocks continue to move higher over the short term. Now, I expected somebody to come off the table. I expected people to get nervous. There was uncertainty. I didn't expect to see levels that we've seen during a credit crisis. Really? That's how nervous you are right now? I mean, earnings are growing. We're doing okay. The economy is pretty fine. It's not great. Housing is okay, slowing down, lower interest rates, refinancing. Look at lower interest rates going forward. It's not a horrible environment. I'm not going to tell you to say it's the greatest environment, but you compare, like, they're positioning themselves similarly to like they positioned themselves in 2008. That was a big surprise to me. Now, if I had an agenda, I'd be like, doesn't matter. I told you, I'm nervous, sell stocks or whatever. And you have to be careful when people have an agenda. So for me, am I confusing you? Yeah, maybe I'd be confusing you right now. Because you're like, well, what should we do? Should we buy stocks or not? For me, I want to get the story right. That's how you become a good analyst. You want to listen to people who have different opinions. For me, this makes me a little bit more bullish. Doesn't mean I'm taking everything I own and throwing it into the stock market, but it makes me not as cautious because the data changed, because I saw something that's a huge data point, a leading indicator that I've used for a long time. And that's important, guys. If the facts change, you change, period. Don't keep running into the wall and making the same mistake. This is what I believe. This is what, don't get stubborn. And it's easy to get more stubborn with the more people that doubt you. It really is. If you like a stock, and people are like, you're crazy for liking Tesla. You're crazy for liking Tesla at 160, 170. What is it, 220 now? Usually when you hear that, it's usually means you're right, but also you become stubborn to the point where you start liking it even more because people are just ragging on you so much. But the point is, when it comes to sentiment, or it comes to researching stocks, you want to look at everything possible. And that survey blew me away. It definitely made me a little bit more bullish, not as conservative anymore. And that's what I want to try to teach you with this podcast. Because so many people out there have an agenda, and they are destroying individual investors. They're destroying your generational wealth. Think about all the guys you've listened to that told you the market's going to crash over the past 10, I won't curse, freaking years. How many people have you listened to that said 30%, then the next year it's going down to 40%? If the market got cut in half from these levels, they still be freaking wrong from their early predictions in 2011, 12, 13. And the worst thing is they think they're right. And to make things even worse than that is they're making a ton of money selling books, revising them. They get paid to go to certain conferences, even though they've been wrong. You know, all these guys own their own company because they worked for anyone else. They would have got fired like 8 years ago, right? So they start their own companies this way they could be wrong forever. No one's going to fire them. But it's kind of amazing when you think about it. So, guys, be open to anything. Be open to changing your mind at all times, especially if the facts change. Did the Fed come out today? Yeah, probably going to lower rates. Not too much of a change. Market didn't really do too much. But just always look at the data, always look at the facts going forward. But if things change, be prepared to change. You don't have to be scared to change your allocation in stocks, to go a little bit more into cash or be a little bit more aggressive. But this survey was very, very interesting. It blew me away. Something I watch all the time, and usually I just sift through it. It's kind of like, a little basic. But some of those numbers I was telling you, pretty crazy. I mean, levels and nervousness you're not seeing since the credit crisis, since 2011, since 1994 with some of these things in terms of allocation and how conservative they are. A lot of that money is going to come into the market, especially as it goes higher, because they need to generate alpha. They need to outperform. And that is definitely a bullish sign for stocks.